Hello and welcome. I'm joined today by our Head of Investment Management, Richard Gray. Richard, good morning.
Good morning, Andrew.
Your team has just published its newly revamped quarterly markets views document, and it's come at a very dramatic time for financial markets. We had a very rocky end to 2018. 2019 hasn't started any calmer. What's your take on all this volatility that we're seeing?
I'm not so sure that it's a huge surprise. I think really the surprise is more the timing than the fact that we've had a market correction. Markets very rarely move in one direction in a straight line, and the fact that markets moved upwards for almost a decade is really testimony to the effectiveness of quantitative easing rolled out by all of the major central banks across the world. And with the end of that quantitative easing, at least in the US, which obviously is the biggest economy and certainly the biggest level of involvement from the central bank, then the fact that we've had a bit of a market correction I don't think comes as any great surprise.
It's the beginning of the year, and I wanted to use this opportunity to look forward a little bit to some of the key themes that are going to impact investors in 2019. Perhaps we could start with the US. How do you think things are likely to unfold there?
Well, the US economy continues to tick along quite nicely. The economy is still adding jobs. The underlying growth is still reasonably robust, probably not as strong as in 2018, where we obviously had the positive effect of the tax cuts. But generally speaking, the economy is going well, and the consensus is for continued economic growth throughout this year.
This week we heard Tim Cook blame a Chinese economic slowdown for Apple's first profit warning in over a decade. Is this going to be a recurring theme in 2019, a slowdown in China?
Well, I think there's three parts to the Apple story. I think first of all there's an Apple-specific issue, and I'm not convinced that Apple's innovations have kept pace with the prices of those devices. So I don't think there are compelling reasons for consumers to continue to upgrade their iPhones. The second thing is China itself. Now, we know that economy, or at least the rate of growth, has to slow. That's just the law of big numbers. Even Chinese policymakers are expecting slightly lower growth this year than next, and I think we're still looking at 6% growth, so that's pretty impressive. But there is an underlying desire to rebalance that economy away from export-led growth to a consumer-led and obviously a domestically generated and away from investment in infrastructure. So that's going to be a theme, and that's been a theme for the last 20 years in terms of Chinese growth. That impacts the commodity markets. And then the third thing is, and I think this is an implication from what Apple was saying, is that the trade spat between the US and China is now affecting US corporates, and I think that's going to be incredibly important. Now, the US-Chinese trade war, I think, is really a manifestation of rivalry, both political and economic rivalry, between the US and China, the two biggest economies. And so I think from that perspective, that won't be a theme for 2019. That will be a theme for at least the next decade, possibly beyond. So I think when you and I are chatting in a month's time, we'll keep on returning to this theme. But the difficulty, I think, for Trump is for him to continue to put pressure on China, which is, a domestic concern. If that starts affecting large US corporates like Apple, then that might take away some of the enthusiasm that the American population has for this policy.
Yeah. Let me ask you about another theme that has longer potential impact than just 2019. Closer to home, here in the UK, 2019 is very much the year of Brexit. How is this likely to unfold? Deal, no deal? What's going to happen? What's your take?
Yeah, one of the things I write about in my note actually is this sort of difference between sort of risk and uncertainty. And I think Brexit very much falls into the camp of uncertainty. It is, as Donald Rumsfeld once famously said, it's an unknown unknown. And the reason being is that I don't think that anybody has a really clear answer as to what will happen in the Brexit process. There are obviously a number of different potential outcomes, from a second referendum to no deal and somewhere in between, either Mrs May's deal or an amendment thereof. But in terms of what gets agreed and what gets past the UK Parliament, I think it's really impossible to know, and that's why we've got a very neutral stance on the UK, because one cannot be certain that it will be a positive or a negative outcome. I just don't think that is knowable right now.
One way or another then, Britain is forging its own path, for better or for worse. How does that leave the rest of the European political landscape?
One of the major factors behind the market's correction towards the end of 2019 was obviously the spectre of slowing growth in the US and this trade spat between the US and China. But also, let's not forget the number of other factors much closer to home, including Brexit, were factors too, as were political uncertainty within the core of the European Union. Now, we've had a leadership transition within the Christian Democrats in Germany, and that's gone relatively smoothly. Italy and France are probably the two biggest worries for markets. Italy because of the populist government there, led by a relatively Eurosceptic party, who are wishing to push the boundaries as far as the European budget rules are concerned. Now, there was a slight compromise towards the end of the year, but that hasn't gone away. And at the same time, Macron, who was the great internationalist and the great saviour of the European project, his popularity has dropped very dramatically. He's seen significant protests at home from les Gilets jaunes, the Yellow Vest movement, and he's really scrambling, and he's had to promise significant spending increases, which actually mean that France will also be in breach of the Maastricht budget criteria for 2019. So the European Union itself, even if you take Brexit out of the picture, is not an entirely certain situation, and obviously, immigration continues to be a significant issue politically amongst the domestic nations there too.
So we've talked about a huge amount of uncertainty, whether it's trade wars, Brexit, the European political landscape. How does all of this impact the way you manage Dolfin portfolios? How do you insulate investors from potential losses?
As I write in my markets piece this quarter, there's an old fishing adage that certain days lend themselves to fishing and certain days lend themselves to the mending of nets. And I think we're in that net mending process right now from an investment perspective. The way in which we're constructing portfolios right now is in a much more conservative way, in a much more risk-averse way. We're holding higher cash levels, we're holding lower levels of equities, and we have transitioned the fixed income part of portfolios away from high yield towards investment grade and government debt, and we've taken duration right down so that we take out a lot of the uncertainty in around inflation and interest rates, and we're also using floating rate notes as well, which provide the same level of insurance. And one of the implications of quantitative easing is that the market has largely been taken out of price discovery, because that's been a deliberate policy of the central banks, is to make people take riskier investment decisions. So I think going forward, as that price discovery returns to markets, as that liquidity is removed, then it's going to be increasingly vital that we as investment managers do the fundamental work to understand the companies that we are either investing in or lending money to. And I think that is going to be a very significant theme for 2019 as far as this process of making portfolios safer and taking on less risk for investors.
Richard, thank you for sharing your insights with us this morning.
Thanks, Andrew.
And thank you for joining us. Please visit our website to download your copy of our quarterly Markets Views document, and we look forward to seeing you again in the next video.